All right, welcome to our monthly meetup, the Texas Multifamily Passive and Active Investors Meetup. I am recording this because we do make this into a podcast, our YouTube channel, and then use it as a recording for those that want to listen back to it. So we are here February 26th, and let's get started. So um, if you haven't been on our meetup, it really is a place where we bring other service partners. Like today, we got James Bohan, and we've got, last month we had Madison Specs talk about cost seg. We've got other syndicator sponsors that come as well. But really, we just talk the good, bad, and ugly of multifamily investing. One of the things I'm going to do differently this year, we've branched into like RV, boat, and business storage. And so we're going to be talking a little bit more about storage in this meetup as well, because the diversification I'm seeing is been really important. But anyway, all this to say, active and passive investors, welcome to join. And ultimately, we try to make this journey a bit easier. Now, we do meet on the fourth Monday of each month, other than December, and that's 7 p.m. Central Time. We've just finished our networking breakout groups, and then we'll do our guest presentation shortly, and then our Q&A networking event. So a little bit about myself. I'm based here in Central Texas. I lead the lifecycle investor relations for CREI Partners. We are focused heavily on value-add multifamily and RV, boat, and business storage in Texas and the Southeast United States. We are buyers. We are not sitting on the sideline right now. There's a huge opportunity to buy properties. Now, it's a bad time to sell, or for those properties that are struggling, not a good time to sell. But for us and buyers and our investors, we're super bullish right now. You can tell in my voice, like I'm super excited about things ahead. There's some really great opportunities that we will be purchasing over the next year. Hopefully having y'all as investors or co-partners with us as well. We've got 37 million assets under management, Texas, Louisiana, and Alabama currently. I worked for a CBRE, a Fortune 150 company previously, and now full-time on our real estate investments at CREI Partners. A lot of experience managing capital renovations, development, and repositioning. You can check out our podcast, The Untold Stories of Real Estate Investing. And we actually are shifting from that. I'm going to start doing weekly updates personally on that podcast, but we're going to be shifting to an entrepreneurial podcast very soon. We also have a book that's about to be launched in the next month or two. So more interesting content, good stuff coming soon. All this leads to CREIpartners.com. So if you want to read podcasts, education, look at our passive investor coaching program, whatever it is, check out CREIpartners.com. All right, enough about me and our meetup. Let's bring in James Bohan. So he is a multifaceted CPA entrepreneur and real estate professional. As the founder of Stonehan, he provides accounting, tax, and fractional CFO solutions to real estate businesses, funds, and syndicators. With more than 15 years of experience, he brings a wealth of knowledge in analyzing real estate transactions, tax structuring, creative financing techniques, and working capital management. In the real estate investment management industry, James is well regarded for his deep understanding of the complexities involved with a multitude of investment assets and complicated organizational structures. Between 2010 and 2015, James earned his California CPA license and was admitted to the Dollinger Master of Real Estate Development program at USC's Sol Price School of Public Policy. He earned his master's in real estate development in 2015, graduating the top 5% of his class and achieving an honorable mention for outstanding performance on the KPMG, or performance on the final comprehensive examination, all while continuing to work part-time for KPMG. He focused his undergraduate studies in real estate finance and international business, earning bachelor's degrees in both accounting and business administration from USC. All in all, just an incredible resource that we have at our fingertips here. I'm going to stop my share, turn it over to James, and go from there.
Thanks, Wayne. Can everyone see the screen now?
Yes, we see it.
Okay, great. So yeah, thanks for hosting me, Wayne. I'm going to give a little presentation over real estate taxes, a little overview over taxes in general. Here's a little disclosure. This is not tax advice. Tax advice costs $1,000 an hour. This is just general information. A little bit about me. Wayne touched on a lot of it. It's Stonehan is a CPA firm and a small family office. I've been a CPA for 12 years. I'm a fourth generation real estate developer, born in Orange County, California, grew up in Las Vegas. I spent my time working for a firm called Rothstein Cass with Abhishek, who's on this call here. And that firm got bought by KPMG. I went and became the CFO of a debt fund at 30 years old, did over $1 billion of transactions, onboarded over 1,400 investors. And then I have 3 degrees from USC, and now I live on a farm in Idaho. So there's quite a few tax advantages for real estate. The Real Estate Association and Lobby is one of the biggest lobbyists in the world, in the United States, that is. And so they lobby really hard to keep the tax rules favorable for the real estate industry. A lot of Congress members and politicians own real estate as well, so they don't want to ding their own pocket. But from a high level outside of that political framework we won't operate in, real estate benefits from having favorable capital gains tax rates when there is the sales. When you hold it, there's depreciation sheltered tax cash flows. What that means is you might get $1,000 in your pocket, but the K1 might show a $500 loss. If you refinance the property instead of selling it, most of the time you
Okay,
won't.
no, this is not for coloring.
This is not for coloring, and the other advantage is those debt finance distributions is when you can take money out of a property, monetize it without a sale, but take money out for a refinance, that's tax free. And then I'll touch on opportunity zones, which came in the TJCA in the last tax bill that was passed, 6 years ago. So starting from the beginning, there are so many different types of taxes out there. And even within income tax, there are so many classifications of income. So on your income tax side, you can have ordinary income, and that could be passive, active, material participation, we'll get into later. You can have capital gain income, and you can have investment income. That's really your stocks, your bonds, your interest, your dividends. There's then payroll and self-employment taxes. When you're a business owner, you pay self-employment taxes on the money that your business makes. If you're a W-2 employee, you pay, half the total payroll taxes out of your W-2. There's sales tax, there's property tax. And there's a lot of people here in Texas that don't have state income tax, but they have large property tax bills. There's foreign tax, there's international tax. Foreign being if you invest in, say, Mexico has a tax. International means inbound to the United States. There's Foreign Investors in Real Property Trades Act. There's effectively connected income. And then beyond that, there's state taxes, not in Texas, although apartment syndications do pay a gross receipts tax. And there can be city taxes. New York City, Los Angeles City, half the cities in Michigan have their own taxes. So there are a lot of taxes out there. And most of the time, taxes are going to be your number one expense in life. Divorce, maybe number one, maybe two, but it's up there. So here's just kind of your current maximum tax rates. Corporations pay 21%. It's graduated. These are all graduated for individuals as well at 37% max. The self-employment payroll taxes I mentioned is 15.3%. That's up to the $168,000 Social Security limit. If you're self-employed, you can take a deduction for the employer side. It gets it to a lower net effective tax. There's investment income tax that applies on interest and dividends. Also, if you're passively invested in real estate, this is a tax that kicks in at certain income threshold levels. There's the additional Medicare tax. If you make too much money in this country, you need to pay for everyone's mental health. That's California's way they call it. This slide is coming a California background. So it's one of the highest tax states that can be at 12.3%, up to 13.3%. New York's, I think, a little higher. Once again, you're all in Texas, so you don't have to worry about that. So now types of income, again, there's ordinary, that's called trade or business. This is also your W-2 wages. There's the interest, dividends, rents from real property, capital gains, and then even capital gains have different tax brackets for them. Collectibles, which is like gold coins, is 28%. And then within the capital gains is this thing called 1231, which is sales of business assets, which is technically what most real estate sales are. And these are all going to be broken out on the K1 you get when investing into a real estate syndication. When you're investing in real estate, you want to understand what kind of income you're going to get. So there's this idea of, are you a dealer or an investor? And you can be a passive investor in a syndication, and this test is going to be applied at the syndication level. So for example, a dealer is a guy who buys a plot of land, builds condos on it, and sells all the condos off. He's in the trader business of like making widgets, but the widgets are homes. So this is considered ordinary income, and it's not eligible for capital gain. When you do what Wayne does, is when you buy something for a long-term hold and long-term appreciation, or you build something and you hold it for over a year, then you can get long-term capital gains treatment from selling that. And that's where this idea of dealer versus investor comes in. So now we kind of get to this idea of passive versus active. And once again, interest and dividends are not considered passive income to the IRS, even though you as an investor will think that's kind of the most obvious investment income thing there is. Those are considered investment income for these purposes of classifying the statuses your investments can be. Now, passive losses can only be offset by passive income. One of the great things about real estate investment is that you get a lot of that depreciation coming through to you on your K1. And unless, and we'll get this in a second, you're a real estate professional, you can't use those real estate losses to offset your other income unless you have passive income. So if you're in multiple syndications and some are selling and triggering that passive capital gain, but you're investing new money into new deals, you can get into this cycle where you'll have realizations of large capital events coming out to you. It will be taxed, but if you reinvest a lot of the money to the extent we still keep bonus depreciation, you'll have this cycle where your passive losses will be offset by passive gains as the properties start to sell. There are other passive investments you can make. Also, if you are a seasoned business person and you're at the point where you can kind of step back and quote unquote retire from your business, there are ways to take your ordinary business, whether you're a doctor or a CPA like me, say, hey, I'm retiring, but I still own the profits of the business, and try to get that classified as passive income. Then you can use all your passive real estate losses to offset it all. And then once again, passive rentals also get hit with the 3.8% investment income tax when you're in the really high tax brackets. So to break it out a little bit more, there really comes down to 4 distinctions of how you participate in an investment or a business activity, as these are really described as. So it comes down to 4: passive, active, material participation, and then real estate professional is another sub-designation of material participation. So passive, that's very easy. This is what's called like LPs, and this because the traditional structure has been in limited partnership, where there's a general partner who takes on the liability and a limited partner who has no liability. That language doesn't technically apply in the parlance of using LLCs from a legal perspective, but people still use the parlance as the same. So if you're a passive investor in Wayne's deal, you invest the money, you get a K1, that's all passive loss to you. Now let's talk about this active scenario. This active one usually comes up as like, hey, I own a single family home with a property manager. I work a day job, but I work with the property manager to oversee management. I approve the tenants. I do a little bit more than just nothing. So under this threshold, you can have your losses up to $25,000 a year under this active kind of participation status. You go one step further, and this is where you get into the material participation. Now you go from passive to non-passive. Non-passive losses can offset non-passive and passive income. So non-passive losses are amazing and the gold thing to get if you're trying to offset active or other non-passive income. This really comes into play if you're running the business. There's a 7-factor test, of which the safe harbor says if you work over 500 hours in an activity, you're deemed to materially participate, and then you get all those deductions, income, expense as non-passive. And then there's one more step above that, and that's where you're a real estate professional. In the stringent tests get a little bit more severe there, where instead of 500 hours, you have to spend over 750 hours materially participating in real estate trades or businesses, and you have to spend over half of your time doing real estate. So me as an accountant, if I'm spending 60% of my time doing CPA work, but 40% of my time doing, real estate development, I'm not going to qualify as a real estate professional. So that's kind of really the distinction of all these different words that you hear, well, you're passive, you're active. It's very nuanced, and this is kind of a very high level overview here. Yeah, Kayoko, do you want to ask a question right now?
Yeah, so I've been wanting to ask this question for a while. So material participation is 500 hours. So to become real estate professional, is it 500 hours plus the 750, or 750, the 500 is already included in that 750?
The 500 is included in the 750.
Oh, okay, great. All right, thank you.
Good question, by the way. So now we keep talking about this, and why? Well, the reason is because depreciation. So depreciation is a phantom expense. You always hear this idea of phantom income, which can trigger if like you get a loan forgiven, or there's more taxable income than there is cash because you're making larger principal payments on a property, which can happen. But it's a phantom expense in that it's not a cash expense. You pay for the building, you pay for all the components of the building, and then you're able to depreciate it over their given IRS lives. So one of the great benefits that we'll get into on the next slide is bonus depreciation. But when you buy a property, you're going to want to break out what assets are part of the residential building, just multifamily as well, commercial, self-storage, retail, office. Those are all recaptured. Those expenses are recaptured, depreciated over that time frame. When you get to F&F, which is furniture and fixtures, it's appliances, if you're putting in new dishwashers or you're putting in laundry units to properties, those are all 5 to 7 year life. Land improvements, which is like your asphalt, your paving, that's 15-year life. Now these assets that are able to be identified outside of the building, they're able to be eligible for bonus depreciation. And in the past, that's been the case where you can take 100% of the deduction in the first year. And then we're in the middle of changing it potentially with Congress right now. It's set to phase out from 20% a year starting last year. But the House passed a law that says retroactive to 2023 and 2026, we're going to bring back 100% bonus. They passed that about a month ago now. It went to the Senate. The Senate had it, to look at, to review. They didn't really touch it. They voted on sending more money to Ukraine and Israel before they took a vacation. They're back to work this week. They might vote on it this week, but this is something that will affect your 2023 taxes potentially by getting more deductions out of this. So that's kind of the current legislation overview. Further on bonus depreciation, you might have heard of this thing called a cost seg before. That's short for a cost segregation report. And like I said before, that report will segregate out all the asset types in the building. So let's say, hey, 5% of the building was for the FF and PPP&E. There was a lot of paving, so 20% land improvements, and then the rest of buildings. So when you do those reports, the main goal is to find out what can be bonus depreciation. And then even if bonus depreciation goes away, it helps identify how fast you can get some of those expenses back. Like with the appliance and stuff, the 5 to 7 year stuff, you can start taking those deductions over 5 to 7 years instead of the longer 39 or 27 year building life. So what is taxable income? It's not, if you get cash in your pocket, the taxable income, well, it depends. So let's say a property has positive income after expenses and depreciation are deducted from rental revenue. Then after depreciation, there's still positive income. Then yes, that's taxable income. What about a partnership makes quarterly distributions to you? Maybe if in the scenario above, they have more income than expenses, that's positive income. But if there's so much depreciation from the bonus assets or otherwise, if you receive cash in your pocket and a basis in the asset, which is a little more technical thing, then no, getting that cash is not going to be taxable income, and your taxable income will be reported on a K1. And when you get the K1, like I said, it'll show out what's ordinary income, what's rental income, what's the capital gain from a potential sell. It'll also show on the schedule what your distributions were. So you can see on your schedule, you might get a $3,000 distribution, but a $10,000 write-off. So some more ideas of what's taxable income. Let's say you foreclose on a note and take title of the secured property. Is that taxable income? That's another maybe. It depends on the basis, if you get anything, or if your just basis transfers over. If your loan gets forgiven, most of the time, unless you meet certain exceptions, which there are a lot, that's considered cancellation of debt income. And so that's kind of like a phantom income where you're getting relieved of a liability to pay something back, but you owe taxes on it. But you didn't get the cash, you just don't have to pay the cash back, but you owe taxes back on the cash you don't have to pay back. So another example of phantom income. Say the property owned in an LLC refinances the property and sends a distribution. Like I said before, that's not taxable income. A question I've gotten before, is a deduction allowed for capital reserves? No, that's just basically putting money in a different pocket. Once you pay for those capital replacement and expenses and make the repairs, that's when those amounts become deductible. So kind of outside of that, I'm going to go through a little more, a couple basic tax things. And this is to explain why you're going to see everything really held in a partnership. So corporations used to be subject to the highest tax rates. They also have double taxation, where once the company makes a profit, it pays taxes on that. And then once the owner of the corporation receives the money, they get taxed on that dividend. That's why you hear people saying there's double taxation in corporations. With partnerships, this is partnerships for tax purposes. They're usually, so LLCs are usually partnerships, but LLCs can be anything. They're a great structure that way. LPs, the limited partnerships I mentioned before, limited liability partnerships, and limited liability partnerships. And the latter two are usually used for professionals, architects, lawyers, accounting firms. And so the way to think about a partnership is that it's more than one individual coming together. So the way the tax code is really written is that it's like, if Wayne and I are individuals and we go out and we do business, everything's going to be reported on our own returns. The IRS's view is that, okay, these two people are in a partnership together, but their share of the assets and expenses should be reported on their personal tax return. If you can understand that and read the tax code, it starts to make a lot of sense the way they set up the rules for partnerships. S corporations are kind of like a hybrid with corporations and partnerships. They borrow a lot from corporate tax law with regards to things like built-in gains on transferring assets out. They have limits on who can own them. They do have some benefits, particularly for operating or management companies. With the LLCs, LP world, like I said, it's a pure flow through. So any activity that's from self-employment will come through an LLC or an LP as a self-employment income tax and be hit by that 15% I mentioned before. With an S corporation, you're able to split that up a little bit. Further, there's REITs. These are corporations that are also another hybrid sort of thing where it's a corporation, but so long as they pass out all of their income as dividends, then they don't pay taxes. They don't pay that corporate tax. It's a nuance with REITs. So if you invest in a REIT, you're going to get dividend income and capital gain income rather than a pass-through of rental income. This has ramifications of for a lot of things, such as 199A deductions. The income won't be considered passive anymore. So you have a passive income you want to write off. You don't want to use a REIT because that'll give you dividends, not passive income. You still do get depreciation sheltered cash flows because the REIT will take the deduction and you only get the dividend on the taxable income. There are a lot of reasons why people use them. They help block state tax filings for the end user. There's a lot of new rules with what's called PTET, pass-through entity tax, on the state level. I'll touch on that towards the end here too. So anyways, that's REITs. Other structures, there's there's a bunch of different types of trusts. There's land trusts you can use to buy real estate anonymously. You can have an attorney set up a trust and only the trust name is on the paperwork. There's dynasties trust, where if you want to start getting some assets out of your estate, if you've invested in a bunch of syndications or own a bunch of real estate, you can set up a dynasty trust, get the appreciation out of your estate that way. There's grantor trusts, there's revocable living trusts. a lot of them are the basic trust that almost everyone should have to avoid probate. The general guidance that says everything owned by a trust at the end of the day, and then that way you can have your trust document say where things should go when you pass away. And then lastly, there's tax exempt entities. So pension funds, IRAs, 401ks, all that kind of stuff. If you have your own self-directed IRA or 401k, you're able to invest in private placements like real estate, which is great. So a little bit more on REITs. This is if you were investing kind of through the stock market. A lot of private equity funds use REITs in their structures as well for some of the reasons I mentioned. It is a tax efficient entity as long as dividends are made to cover the taxable income. REITs have more rules to comply with being a REIT. They must have a significant amount of assets and their income come from real estate. No more than 5% impermissible tenant services can be allowed. In the world of self-storage, that could be I've done a lot of the analysis of this for pension funds, but if you have a self-storage thing and you have a store on site selling locks and boxes and stuff, that's not real estate income. So there are ways to structure around that, but that's just kind of the idea there. And then REITs don't allow dealer properties. So that idea of building condos and selling condos or building homes and selling homes won't work for a REIT. Everything has to be held for at least 2 years. Otherwise, it's considered a prohibited transaction and subject to 100% tax. So this is kind of a chart of how most syndications or any real estate investment really gets done. So you'll have your propco here, or the deal entity LLC, as I'm calling it. Most people use LLCs these days. Some people use limited partnerships. If you have investors from Canada, they have a weird thing about LLCs, so you still see them out there. So the investors will come in. This is the idea of the LP, the limited partner. Technically, they're called a member of the LLC, and usually they'll have a manager or a managing member. There's legal nuances, and I'm not an attorney, so don't ask me about that. But I keep clicking it. But the promoter entity is the S Corp, LLC, or LP, and then the promoter, Wayne, in this area, the syndicator, is here. So he'll be the manager of this entity, be authorized to manage it, buy the property, open bank accounts, and generally just conduct the business and oversee it, send distributions to the investors, and take the fee income that they agreed to for running the deal. One thing that came out of the last tax bill was opportunity zones. This was a really exciting thing 6 years ago when it happened, but they're still around and people are still doing them. The benefits used to be a little greater because they actually reduced the capital gains tax you would pay, but that game is out the window right now. So what you can do now is if you have any capital gain from anything, that can be Bitcoin, stocks, real estate, you sold some gold, you can invest the gain money into an opportunity zone and get certain benefits. This is different from a 1031, where if you sell a property, you have to invest all the proceeds, principal, and gain. Here, it's just the gain that can be invested. If you invest in an opportunity zone, you can defer tax on that capital gain you triggered until 2026. So you get the time benefit of money there. If the new opportunity zone is held for over 10 years, the new investment pays 0 tax on the sale. This is insane. It's very rare in the tax code that you'll ever say they completely eliminate the tax on something. This was very exciting and something that's still going on. And you have until the end of 2026 to invest in one of these opportunity zones, and then it goes away. And then one of the other things is you must substantially improve the asset. They don't want people investing in these impoverished areas and just letting everyone do the work and riding the lift. You must invest at least 100% of the building value that you buy in order to qualify for all the opportunity zone benefits. There's a lot of nuances on when you can get out of these, but this is a high level benefit. Like I said, the tax code is set up to invest in real estate, and this is another great example. So that kind of concludes my high level overview of real estate taxes for passive investors. We can open the floor up to Q&A here.
Hey, great job, James. A lot of information. We have plenty of time for Q&A. If y'all want me to read out your questions, definitely put it in the chat box, or I believe you can raise your hand and I can, or James can call on y'all. There was one question here. What were those acronyms? It was like F and F.
Okay, I see the chat here. Yeah, FF, PP&E, furniture and fixtures, property, plant, and equipment. It's just anything that if you put a new Viking stove in, if you, like I said, you put a washer dryer or you put appliances into a building, that's usually where the F and F will be seen. It's your personal property. That's a distinguishing thing between real property, and that's when you're able to use the bonus depreciation. Depreciation recapture and how this is taxed. So thank you for mentioning that. It was a bullet earlier. I kind of skipped over it. So depreciation recapture is also called Section 1250 recapture. The idea is that if you've depreciated a building over time, let's say it's depreciated $100,000, when you go to sell it, the IRS looks at that loss that you took before and requires a recapture, not exactly at ordinary tax rates. They apply a 25% tax to that. So it's a little more than the capital gain, a little less than the highest ordinary income threshold, but it's still overly advantageous. It's just something the IRS catches up with at the end to kind of even out the fact that you took deductions along the way. Outside of a 1031, can you reinvest or do something to avoid recapture? The only other way I've heard about that is with the opportunity zones. So the new investment you hold, if you sell it, like I said, that's a 0% tax on it. And the way the IRS technically explains that is that if you've held your new opportunity zone investment for over 10 years, at the time of sale, the basis of the asset, and so the basis is what you paid for minus depreciation, high level. The basis of the asset becomes your sales price, which is insane. So 0% recapture is 0% capital gains tax on an opportunity zone investment. That's one of the other ways I've seen to avoid recapture.
We have a hand raised in the audience. If you want to go.
Sorry. About depreciation recapture. So I read that if it's not a straight line depreciation, you can't do depreciation recapture at 25% or 28% or something like that. So if you do cost segregation, can you still do depreciation recapture at 25%, or does it become ordinary income?
My understanding, and let me double check this with you to make sure it didn't change, is that depreciation real capture is still capped at 25%.
Oh, okay.
Like I haven't seen on a K, like, because how it works is on a K1, you're gonna get things as 1231 gain, long-term capital gain, short-term capital gain, and then section 1250 recapture. I haven't seen that section 1250 recapture be broken out between long-term capital gain and short-term or not other recapture, but it could come back as a line two. We have another tax partner in here, Abhishek. Do you can you help me out here?
Yeah, so like you mentioned, if you do a cost seg study, then you have assets which are not real assets. So a recapture related to those assets is a 1245 recapture, and that will be taxable at ordinary rates. But when you sell building and land, that's a 1250 recapture, and that's taxable at 25% rate. So to answer your question, there will be ordinary recapture as well, depending upon if there is sale of ordinary assets, which is not real assets.
So, right, those ordinary assets are the FF&E. And then Abhishek, how is that report on the K1? Does that come through line 2 rental, or I haven't seen a section 1245 recapture on a K1 before?
Yeah, it just goes to line 2.
Line 2, right.
Yeah.
Okay, thanks.
And then James, you have your screen, the Investopedia up. I don't know if you mean to or not.
Nope, was just trying to get the answer to the question.
Cool. Any other questions? Again, if you don't want to read out loud or anything because of the recording, I can read it that way. James, while we're still recording, for those that listen via audio, can you let us know how they can reach out to you because they may not have the slide in front of them.
Oh, good call. Yeah, James Bohan. I'm available at stonehan.com. You can reach out to me via the website there.
All right, I'm gonna stop recording and then we'll hang out in the group here for a few more minutes. But appreciate James. Thank you for being on and all that you do for us.